Money Show.
Personal Finance with Warren Ingram.
What are the big 5 mistakes that people who lose money permanently make? What are those big 5 mistakes? Warren Ingram, personal financial advisor and executive director at Galileo Capital, regular Thursday night contributor to The Money Show in the terms of personal finance. And Warren, I don't know where we start with this. I mean, generally, I think most people get themselves into trouble probably when they go out and take their big first high value loan to buy something they probably don't need or something they thought they needed and end up taking on too much debt.
Absolutely, Bruce. And I think it usually happens in the middle of some other unexpected movements, either in their own lives, in the economy, or in investment markets. I think just jump back to the beginning of COVID. People borrow money because they're buying a house or they bought a car, and suddenly they find themselves out of work because the world shuts down, and so they're in a position where they've got to access whatever money they can. And fortunately or unfortunately, they have investments, but those investments are suddenly down 20 or 30 or 40%, and they've got to sell those investments no matter what because they've got debt to pay and no income to pay it with. So they find themselves in a terrible position where they sell investments at discounts that will never be recovered, and they use that money to settle debt. And so they experience one of life's one investment life's great tragedies. Borrowing too much when you simply can't afford it, and then having to cash in investments at the worst time. And lest we think it's just individuals, it's also professionals. One of the all-time famous big investment blowups was a company called Long-Term Capital Management, which was filled with Nobel Prize winning economists. They did exactly the same thing. So it's don't feel bad if you're a private investor and you find yourself in this problem. It happened to some of the brightest minds in the economic world as well.
And it's common, and it happens in every cycle, because particularly when money is cheap, as it has been for the last 2 years, people do tend to go, well, I can afford this, and forget that interest rates do eventually go up. And sometimes they can go up really quickly, and sometimes they can go up really quickly by quite a lot, as we've seen happen in the past. Less likely now, fingers crossed, but possible.
Absolutely, and I think one function will be your big interest rate moves, and especially for people who've borrowed money for a home loan, for example, or a car that represents a huge part of their monthly repayments. It doesn't take a big jump in the interest rates to catch you off guard, and especially if you haven't done that sort of budgeting effectively, where you've got enough capacity in your monthly expenses to cover an extra 1 or 2% a year interest rate jump. And it might not sound like a lot when someone says 1%, but if it translates to 2,000 or 3,000 rand a month extra, and that sets you in the red on a monthly basis, then you've got the problem of a debt that you can't repay on your home, for example, and you're having to fund it from credit cards, and then you're in a whole heap of trouble very, very quickly. So it's one of those things you just have to really be careful. Borrowing money is fine for the right reasons, and making sure that you've got sufficient cash to cover any unforeseen expenses is critical in that. And always make sure that you can tolerate an extra few thousand rand a month's worth of interest rate jumps if that's what happens. And I think you're right, Bruce. Listening to the Americans now, their inflation rate is shot through the roof. They're in for a nasty surprise that where their reserve bank's going to have to push up interest rates. They're going to be in the same position. So you're right. It is common everywhere.
I bumped into somebody from the world of the arts the other day, and they were looking a little bit grey. And it wasn't because time had passed and I hadn't seen them for a while. And I said, what's wrong with you? You look like you've been going through some stress. And they say, well, SARS is all over me. And I said, oh, my goodness me, why? And they said, well, I didn't put money aside for provisional tax, and my income dropped, and I was spending my income, and I wasn't saving the money I used to save and putting aside to pay the tax when it was due. And then the tax came due and there was no money. And no wonder they were grey. And I think this is also fairly common, particularly, not necessarily in just that scenario, but there are a bunch of people doing some quite highfalutin stuff when it comes to money that aren't necessarily thinking of the financial consequences of making a profit.
It's a volatile time now where we find lots of people have been trading in shares. It started in the US with sort of the Robin Hood traders, buying shares and watching them shoot up, and they were sort of buying and selling on a rapid basis and making some decent profits. Some of them, not for very long, but they did make some good profits. And what you found was that they just kept going, and all of a sudden gets to the end of the year, and the receiver turns around and says, "Well, you've made X amount of money as profits. Where is our share of the taxes?" And for people who've been doing that, I notice it's happening here as well. They call it fin Twitter, but financial Twitter is full of people punting individual shares on the JSE and how these shares have, until a couple of weeks ago, have been really shooting up, and people bragging about their trading profits, which is interesting because SARS is quite sticky on things like this. If you buy and sell shares actively within a 3-year period, in other words, you buy a share today and you sell it, let's say in 18 months' time, and you sell it for a big profit, there is a very good chance that SARS turns around and says that profit that you've made is not considered to be capital, it's considered to be income. In other words, it's part of the way that you generate a monthly or annual salary for yourself, and therefore you owe us, let's say 30 or 40 or 45% tax on those profits that you've made. And for people who haven't budgeted for any kind of tax on their profits from share sales, they're in for a nasty surprise. And SARS is not understanding. If you don't have the money, you owe penalties as well. And suddenly, things get really scary. And then for my favorite class of traders, those who are trading profits in cryptocurrencies, exactly the same principle applies. The fact that you're not trading in fiat currencies and stock market listed investments doesn't mean that SARS doesn't want a share of the profits that you've made. And if you are trading in them, if you're actively trading, again, expect a nasty surprise where SARS says we are owed income tax on that money. And that's a huge problem for a lot of people, because that will happen at a time when they can't afford it. For example, now, investments are going down. And people might not just have that accessible money anymore because their investments have lost 20 or 30% of their value, even though they made those profits in the previous tax year. They're still there and they need to be paid.
Yeah, absolutely. And when you look at, there was a time when I wondered why anybody bothered buying anything other than Naspers, because Naspers was the market. Naspers made the market. And if you were only invested in Naspers, you were making so much money. And now if you were only invested in Naspers, you'd be losing so much money. And it's something I've never been accused of, which is concentration risk. The ability to focus all of your attention in one particular place at one particular time is a good thing if you're studying for an exam. It's terrible if you're putting money away for a rainy day.
It's a situation a lot of people are facing now where to use your Naspers example, the share price has taken a massive hiding. And I've received a number of inquiries from people to say, shouldn't I take money out of my bond and just buy Naspers? Isn't this a great idea? And then, I'll ask them the follow-up question, which is, how many other shares do you own, and how much of this will be, a part of your whole investment portfolio? And they go, what do you mean? It'll be my first share, and it'll be, it'll now be my biggest share. And if Naspers does shoot up in value, and who knows what it will do next week? I mean, none of us can predict that. But if it does shoot up in value, then you've taken a big calculated risk, and it's worked out. But what happens if the Chinese regulators do something else to affect Tencent and put fear in investors in emerging market tech again, and your Naspers or Prosus shares lose another 30%, and now you've done it with borrowed money. So taking all of your eggs and putting them into that one basket, and then that basket drops, is just a scary thing to do. And it's so tempting for a lot of investors, who kind of become almost fanatical about a particular investment. And I think, we're talking about shares now, Bruce, but the exact same applies to property. A lot of the time, a new investor will say, okay, I own a house. What I'm going to do now is I'm going to take out a bond on a new property, and I'm going to rent that property out, and I'm going to make lots of money because my tenants are going to pay off that bond, and the bond, the property prices will shoot up. And it's a very nice textbook theory. I wish the investment world, succeeded in textbooks. only, and we can all make money all the time. Unfortunately, in the real world, you get things like tenants not paying, you get things like property prices falling, rates going up all the time, Eskom, prices going up, and suddenly property ownership becomes a very expensive thing. And that's also concentration risk. It's also too many eggs in one basket.
Absolutely. And then people who go, you know what, I believe in property. I'm going to buy just property. Or I believe in cash. I'm going to put it in the bank in a fixed deposit. Or I believe in just gold. Or I believe in just Bitcoin. Or I believe just in shares. And it goes against this whole notion of diversification, which I think we've learned. When markets were going up and everything was going up in a straight line, diversification seemed like nuts. There's something crazy. But when things go bad, diversification truly stands out as a strategy that matters.
Yeah, and when markets become incredibly volatile like they are now, and it's from a surprise, a shock to markets. We saw that both in the initial COVID crash and now with the Ukraine situation. A lot of investors become almost binary in their thinking. In other words, they go all in or all out. And the number of calls I received, in the kind of 2-3 days after the Ukraine was invaded, from people saying, don't you think we should just sell all the shares and just move to cash? And let's just wait for this whole thing to resolve itself and then, let's buy in again. So now they've made an all or nothing decision. We're not in shares anymore. We're not invested. We're just going to be 100% in cash, and we'll just wait for things to stabilize. The same thing happened after the COVID crash. We don't know what's going to happen. This pandemic could destroy the world. Let's just move everything to cash. The problem is when things are so uncertain, there is a very good chance that cash loses value as well. I'm not saying in absolute terms. In other words, I'm not saying your 100 Rand suddenly goes to 90 Rand. But what happens is inflation starts to kick in and the buying power of your money gets eroded. So you're right. Diversification is key there.
And also, one last point, because we need to move on, but just don't invest money that you might need next year. If your car's a bit rattly and you need to buy a new car, don't go and invest that money now, because you don't know what's going to happen to markets. So please don't invest no money that you need in the short term. A question from Tato this evening, Warren. I need to make some good financial decisions. I've got some debt and I'm paying this off, and I allocate a little bit of extra money to pay off the debt faster to become debt-free. But I've noticed that markets are down thanks to the situation in Ukraine, and I think this presents a good buying opportunity because markets are offering discounts. Pays attention, does Tato. Should I use the extra money to add to my investments instead of paying extra on my debt? Great question, Tato. That answer with Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Tato's question this evening, and as I look up at my screen, I see an American called Brennan Schlagbaum. Of course he's American. Posing exactly the same question, Warren, but slightly differently and more succinctly. Should you pay off your debt or invest first? Because Tato wants to pay off some debt, but is tempted by dripping roasts, as they call them in the market. What should he do?
It is a brilliant question. You're right, because there are many ways to cook a roast, Bruce. And I think when you're in this situation, and I'm Tato, I'd be saying to myself, what's the debt that I've got? Is it credit cards, personal loans, overdrafts, microloans? Because if it's any of those, then the answer is doesn't matter how good the investment opportunity you're being offered, settle those debts, because those debts are costing you a huge amount of interest, and those debts are pretty much guaranteed. It's like earning a guaranteed return on your money. And it's tax-free because all you're doing is paying off debt. And so I think that's a no-brainer to me. You settle the debt. But if it's something like a home loan where your interest rate might be fairly decent and you've got a fairly long time horizon on your investment, on your debt, then it's not a bad idea to take a portion of that extra money that you were paying off into the bond, because it is extra money. It's not just the minimum required. And take that money and buy into investment markets now. I think Tato's right. The investment markets are offering fantastic value. And certainly people who buy into the markets at these levels are not going to regret that decision over 5 or 10 years. They might be unhappy over the next 2 or 3 months. None of us know the answer to that. But I think over 5 or 10 years, certainly a good idea. So I think that you can
are going up, Warren. That's the trouble. Money's going to become more expensive in the next 12 to 18 months.
Sure, but if it's on a home loan, for example, and you are paying off what's required already, and this is extra money, and you have been paying extra money for a while, then Tato's already got some kind of fat in the system there, and that's a protection against future problems, and so. For me, I think that there is merit in looking at this as an option. As I said, there are many ways to cook the roast. So for people, for example, whose income might be pretty uncertain or unstable, then definitely keep paying off the debt faster and use the low interest rates to your advantage. But there are times, and I think this is one of them, very few times in an investor's career where the markets are just irrationally priced. They are just putting things at too much of a discount, and then you should take advantage of other people's irrationality. And I feel strongly this is one of those times, Bruce.
Okay, excellent one. I've got a phrase for you, and I like this one because it's one that, like so many of these phrases from the market, we take for granted. What is a dual listed share? Companies like Anglo-American, like Investec. Investec is not dual listed though, is it? Because it's got a different structure to the way in which Anglo-American is listed. Is there a difference between the two?
Yeah, so a dual listed share, very simply, is a company that for example, if we use the South African Stock Exchange, you might have started in South Africa and you become a big business in South Africa. You listed on the JSE, and now you're starting to kind of outgrow the South African investor market. And so you say, well, I need to access a new pool of investors that aren't available to the JSE. Or to JSE listed shares, and so I'm going to go and list myself on the Dutch Stock Exchange or on the British Stock Exchange or potentially the American or the Swiss. And South Africa's got a large number of these companies that have, I think through the legacy of apartheid, become very large in South Africa. And when the country opened up, found themselves being massive businesses in a very small stock market and very small economy, and have then listed themselves elsewhere. And so, that's the kind of the simple basis. They do get, you do find these things becoming a little bit more complicated. So, for example, a very big business in China might say, well, I'd love to be accessible to American investors. And what they'll do is then list a thing called an ADR, an American Depository Receipt, on the American Stock Exchange, so that Americans can also buy the share more easily. So it's quite a well-known structure around the world. They do get very complicated. So you do find, I'm kind of tiptoeing around your question because it's going to take us another 15 minutes to answer. But you do find inwardly listed shares as well, where the structures become kind of a bit more complex and the taxes around those a bit more tricky. But very simply, dual listed. A share that's listed in two separate exchanges, and sometimes could be 2, 3, or 4 different exchanges, depending on what the company's looking for and the investors they want to access.
Warren Ingram, personal financial advisor and executive director at Galileo Capital, on a Thursday night here on The Money Show.